Welcome. Welcome to my garage. It's a bit echoey in here. This is where I'm going to talk to you about Michael Porter's essay on competitive advantage. Porter's a really famous guy in business strategy circles. And so if you sort of talk to anybody who went through management education over the past, 30 years, they're probably going to be familiar with Porter's analysis. And so this is not some obscure piece that we're doing. This was published in the Harvard Business Review in 1979 and had a lot of impact. So what's it about? Well, here is Porter's story. He wants to know, when can an organization earn over the long term really good rates of return on its investment. Now, this can be a commercial firm, and so say it's a commercial firm that has invested money in capital and buildings and so on, and earns sort of a rate of return on that investment, a rate of profit that is above what we ordinarily see across the economy in an average firm. All right, and in particular, he wants to know, how can you maintain that over a long period of time? Because, if I'm running some business and I'm doing really, really well, and it might be that I have a commercial business, say I have a restaurant that is making, lots and lots of money, lots and lots of turnover, being super successful, or I might be in the nonprofit world. I might be running a nonprofit resident theater company in my city that is just doing, fabulously well, big audiences, big revenues, and so on. And Porter wants to know, how can I sort of maintain that strong position in the long run, right? I might be able to have it for a while, but maybe not for decades and decades. Well, why is that even a question? Isn't a strong business a strong business? Well, no, not quite, because if a business is very successful, then there are going to be other entrepreneurs who look at the situation and say, boy, I could make something out of this, right? If that restaurant is so successful in this city and making so much money, why don't I start one that looks sort of like that? And maybe some other people might get the same idea. Now, of course, what's going to happen is, as these other entrepreneurs start their competing restaurants, then the first restaurant is going to find, well, his business starts to decline. I mean, it's all these new places are taking up some of their customers and so on. And in fact, what used to be something fabulously successful now becomes something fairly ordinary, in the fact that there are now a dozen restaurants, fairly similar, offering competitive prices and all just getting along. Our nonprofit resident theater company, which is doing so well, it inspires arts entrepreneurs to say, well, maybe this is a really good city for theater. Maybe I can set up my own company. They start to do that. But again, there's only so much audience out there. And they might start to find that, well, it starts to diminish and it comes into a fairly competitive situation. So that's what Porter wants to do. And the essay is, and you have to kind of look closely to see this, and that's why I'm going to try and explain it in this video. Actually, two videos. The essay comes in sort of two parts. And one part is on what Porter and everybody else calls barriers to entry. So suppose I do have one of those really successful businesses. What factors might be in place that actually make it really difficult for a new firm to enter the market? Maybe my sort of, dominant position as sort of the restaurant, the theater company, is actually pretty safe because it's actually fairly hard for entrepreneurs to come in and set up. So that's one of the questions that Porter is asking. The second question he asks is, well, suppose you are in a position where you're earning good returns. What are the factors that sort of lead to that? So put competition entering the market aside, and just look at just your firm as a firm and what gives you sort of strength in all of the relationships that you're involved in, whether you're a commercial firm or a nonprofit. I'm going to do that in the second video. In this first video, I just want to talk about barriers to entry, okay? So, Porter lists 6 in his article, and they're a good 6, and we'll discuss them in a bit of depth. People after Porter published added a 7th, and I'll get to that. So this is sort of a 6+1 example. So you've got a very successful business. It's earning well above average rates of return. What prevents other people from entering the market? Well, let me go to my high-tech screen sharing device here, and I've written out Porter's 6 barriers to entry. The first one is economies of scale. Suppose it's the fact that a bigger firm can always essentially operate at lower costs per unit than a smaller firm, okay? Suppose there's big economies of scale. If that's the case, the market is really only going to be able to sustain one big firm. Because anybody who tries to enter the market is going to find that their costs, because they're smaller when they start out, are always going to be higher than that one big dominant firm that's in there. So economies of scale often lead to one single firm. In some industries, it becomes so dominant, say in public utilities and so on, that the government feels a need to step in and sort of regulate what kind of prices it's charged. Okay? The second aspect is product differentiation. Okay? So suppose you have a product that essentially new entrants can't really compete with because yours is so unique. You have established a brand, right? A well-known brand that consumers trust, and new entries can't just buy that. That's not a thing you can just spend money on and just have. So if you have sort of that really strong brand advantage, everybody knows your place, everybody knows your theater company, everybody knows your restaurant. That makes it tough for a new competitor, okay? Because they can't really duplicate what you've got. They're not going to have that sort of market trust. So that's going to be hard for them. The third thing Porter points out is capital requirements. All right? Now, what do we mean by that? Well, suppose it's the case that to start a competing business, you have to make a really big investment. You're going to have to get a building, you're going to have to do a bunch of research, you're going to have to do a whole bunch of advertising. That makes it a very risky venture for any possible competitor. So suppose you were going into a town with one really strong resident theater company and you said, I'm going to set up a competitor. Think about all the costs you would have to spend money on before you even saw a dime of revenue, before you were able to approach any donors with the prospect of their giving you money. And also it's extremely risky. What if it doesn't work, right? You've lost a lot. So big capital requirements can be a real challenge. And in fact, one of the things we talked about in the last video, our great dance studio example, we mentioned that the existing dance studio, remember Acme Dance? We said that they might actually go really big on spending on capital, thus forcing any rival to sort of match them in that and making it a fairly risky, fairly difficult thing to do. And so we do sometimes see companies almost looks like they're over-investing in capital, but it's a way to create these barriers to entry. The fourth thing Porter raises is cost disadvantages not related to size. And what does he mean by that? Well, we already said economies of scale. Suppose just being a bigger firm means that you can do things cheaply. But what if there are advantages you have that actually aren't related to size, but are just related to your being there first? So suppose, for example, there's a certain amount of labor talent that you need to work in this business, and the existing firm has sort of scooped them all up. They've got all the best, most skilled, most experienced people already working for them. They might have special knowledge. They might own intellectual property that really can't be duplicated. So that existing firm might have a lot of advantages that even though they're not very big, they're not things that a competitor can really pick up. That would be another barrier to entry. That's Porter's fourth barrier to entry. Fifth one, access to distribution channels. This is kind of an interesting one. How do you get your product on the shelf? This is especially important if you are sort of making something or providing something, but you have to have some route to get it to consumers. And what if you don't have good access to that? So in food services, but also in the arts. This is why you do find that, say, in the movie business, in the recording business, while there might be independent firms, they are often linked or work through the big firms just to get access to distribution. That's why in the movie business, for example, there's lots of independent studios, but there's only a small handful of major studios that really have access to distribution. In fact, if you make an independent film and you want it to be seen on a lot of screens, it's going to have to be picked up by one of those major studios, and that makes them really hard to displace. A business I would not want to go into right now would be to try to make a major new movie studio, right? And we don't see any major ones. We see the existing ones being bought and sold, but we don't see anybody really trying to cut into that market. But soft, maybe there's an exception. One thing we have seen in terms of distribution is Netflix and Amazon Prime. And what have they done? Well, they have, interestingly, created their own distribution channels. So they found a way to make original content, original film, and they have not tried to get it into cinemas because the major studios kind of have all the access to those distribution channels. So that makes it pretty tough. But what they can do, well, they can stream it directly into your home. And they've been remarkably successful at doing that. So kind of an interesting one, they created their own distribution channel. Another example Porter gives was for the longest time in the airline industry. It was very, very tough to set up a new airline because you did not have access to spaces at the major airports. The one major competitor that came about way back in the day before most of you were born is Southwest Airlines, which is a fairly new airline. And the way Southwest got started was it actually didn't fly to any of the major airports. It got into business by flying people place to place using small regional airports rather than big national hubs, because that was the only way it could do it. That was the only way it was going to get past Delta and United and American and the other major carriers. All right? Porter's sixth one, government policy. This is an interesting one. So suppose you are the dominant firm, and you simply ask the government, can you please limit the number of suppliers? Now that sounds pretty weird. If I was running a business, could I actually ask the government to limit the number of suppliers? But in fact, we see it all the time. We see in the hospitality industry, we see restaurants have a strong influence on trying to limit the number of new liquor licenses that are awarded. It's hard to say you can't, it's hard to limit the number of restaurants, but you can limit the number of liquor licenses. Businesses will try to use policy to limit competition, to make themselves the strongest one. It's actually an issue that has come up in arts policy. One of the things that we talk about in our cultural policy classes is local arts policy when there was talk of having an earmarked fund for the arts. Okay? Now, an earmarked fund for the arts, just in brief, and you might have covered this in other classes, is where a dedicated portion of a tax goes to the arts on a guaranteed basis. So in Denver and Salt Lake City, they have part of the sales tax that goes directly to arts organizations. In St. Louis, part of the property tax does that. In Columbus, Ohio, and in San Francisco, they use part of the motel tax for it. And in Cleveland, famously, they had a very strong tobacco tax that was earmarked for the arts. In fact, Professor Gall Mills used to run that fund. Now, what do you get when you have those kind of funds? Well, one of the things that you find in the political debates that happen around the establishment of one of the taxes like that is existing arts firms, right? The symphony you've already got, the big art museum you've already got, will ask, okay, with this earmark tax, can we get a guaranteed piece of that? Okay, so we don't want to have to apply for funding every year. We just want some of it guaranteed that it goes to, Springfield Symphony or Springfield Art Museum or whatever. Now, think about that for a sec. right? If that's the way your earmark tax works, so that a guaranteed chunk of it goes to existing arts organizations by statute, what does that say to any potential competitor? Anybody who thinks, well, maybe I want to start a symphony orchestra, or I want to start an art museum. Well, too bad, because you're not going to have access to that funding. So that becomes kind of a barrier to entry there. Okay, what's the barrier to entry that Porter doesn't raise? And it's very important in our economy, network externalities. This actually is too low. Network externalities. All right, what do we mean by network externalities? Well, let's think of Facebook, okay? Facebook has a very, very strong market position. If any of you are thinking of being an entrepreneur that's going to start the new Facebook, I'd maybe advise you might want to look in other directions. Well, what makes Facebook so strong? People join Facebook because other people are on Facebook. They might not even think Facebook is all that great. They might think that, there's a lot of problems with the software. They might not like the company, but there's a lot of people they want to connect with who are on Facebook, and therefore you're going to do it too. That makes it really, really tough to start a competitor to that, because people don't want to leave Facebook to go to a competitor unless everybody else does at the same time. But that's not going to happen, right? People aren't going to do that. And so they get a very secure position. I would say Microsoft is in a similar position. Think about their Office software. You know that if you write a document in Word and you send it to somebody, they're going to be able to open it, right? They're going to be able to open it because they're going to have Microsoft Office too, and that's not going to be a problem. If you wanted to set up a new suite of Office software and get that distributed, it's going to be hard. It's going to be hard because you're competing with sort of a technology that everybody knows and everybody likes to share. So that's called a network externality. People are using one particular firm because everybody else is using that firm, and that makes it really hard to dislodge. I had a professor when I did my master's degree, a guy named Preston McAfee. He went on to teach at Caltech, and he wrote a book, sort of a textbook on business stuff in 2002. And he actually had a chapter on this Porter stuff, and it was interesting because Porter's essay was from 1979. McAfee wrote in 2002, and so he came up with some new examples, and some of them were fairly interesting because you were starting to see the development of tech firms. And he had some interesting insights in terms of which of these tech firms had a very secure position, according to Porter's analysis, and which would be vulnerable. There was one he correctly pointed out. He said that Yahoo, and I don't know how many of you remember Yahoo was in 2002 the dominant search engine. Okay, it was the one everybody used. But Preston McAfee said, you know what? Their position isn't that secure because they don't have those kind of externalities. If somebody comes along with a better search engine, nobody's going to be loyal to Yahoo, right? And so if somebody comes up with a good search engine, I'm just going to start using it. I don't care what my friends are doing. And if they can do that and get that distributed, they're going to be dominant. Well, Google, of course, which didn't exist in 2002, Google became the dominant search engine because it was better, and it was able to displace Yahoo simply by being better at that. There were no network externalities. There was nothing really protecting Yahoo's position. The other interesting example McAfee gives is Amazon. Now, of course, Amazon is still around, and Amazon is wildly successful. So what explains that? Well, McAfee said that Amazon was vulnerable because, here you have this online shopping and delivery, but if somebody else starts offering online shopping and delivery, we'll use it, right? If somebody else offers better prices, why not? I don't need to use Amazon. So why is Amazon so dominant then, if they could be so at risk? Well, I think there's a couple of factors. One is that Amazon really did try to build up consumer loyalty. So Amazon Prime, free shipping, just getting used to it, building up that brand. That was part of it. The other part of it is when it comes to actual just ordering and delivery of goods, Amazon really doesn't make any money out of it. That's why they have to keep their prices so low. It's not the profitable part of their business. They seek their profits everywhere else. So they use what started as just an online bookstore as their entryway, but it's really Amazon Web Services and stuff like that is for them really where where the money is. Okay, so interesting examples. Last example that Porter gives is Dr. Pepper. And I found this one interesting because, of course, Dr. Pepper has been pretty successful. And he pointed out that Dr. Pepper was pretty smart when they entered. The fact that it's still around must mean something, but he says, they were going up against Coca-Cola and Pepsi, which are, two pretty strong market dominant firms. How did Dr. Pepper get in? Come up with a unique product. So one of the first things Dr. Pepper said is, don't try to take them on. Don't make a cola. Make something else, right? Because you're not going to have a third brand of cola that's going to displace those two. So come up with a different drink. Don't try to create your own distribution channels. Try to use existing ones to get in, because otherwise that's just going to be huge. Start with small plants, and Dr. Pepper was able to succeed. So that is Porter on barriers to entry. And that is the first video I'm making on Porter. The second one is going to be about, when you're in an industry, what actually gives you a lot of market power? How are you able to earn those high returns? So for that, you have to go to the second vid. Okay, thanks from Rushton's Garage.